This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Magic number. With inflation pressures building, is this vital sign finally at the level the Federal Reserve has been looking for?
Big gains. New home construction surged in June, but it isn't all good news for the housing market.
And Market Monitor, our guest tonight, says now's the time to invest in a sector that's seeing massive merger activity. All that and more tonight on Nightly Business Report for Friday, July 17th.
Good evening, everyone. Happy Friday. The economic picture may be coming into focus. Inflation pressures appear to be building, and that's something the Federal Reserve has been waiting for a long time. Consumer prices rose for a fifth straight month, up 0.3%, as the cost of gasoline increased. But prices may not be at the Fed's magic number just yet. Vice Chair Stanley Fischer warned today that inflation is still too low.
It's too low now. I never thought I'd live as a central banker to see us complaining about low inflation, but here we are complaining about low inflation with reason. And we need to get it up to around 2%, and if it ever goes above, we need to keep it there.
And a closely followed barometer of the health of the housing market came in above estimates. Construction of new homes jumped nearly 10% in May, but all of it was in the multifamily apartment side, which hit a 28-year high. Single-family home building has been limping along in the recovery. Builders say there is demand, but as Diana Olick reports, they're up against a major obstacle.
In Allen, Texas, homebuilder Bruno Pasquinelli would like to be framing more single-family homes, but he can't.
There is not a great probability of increasing our production right now. There are not enough men to make up the slabs. There's not enough workers to pour the slab. After the slabs are done, there's not enough framers, there's not enough masons, so there is a severe shortage here of vendors.
Builders across the nation are reporting labor shortages, so much so the problem was even cited in the Federal Reserve's latest report on the health of the U.S. economy. Back in Allen, Texas, it's even hurting the quality of new homes.
The quality is not as good as a home was built, probably 10 years ago.
Unemployment in construction fell nationally in June to the lowest level since 2001. More than 2 million workers left, and the industry cannot get them back.
You can't create a skilled construction worker. It takes years to get the training to be able to put together the steel frame of a high-rise building, or to be able to operate the heavy equipment to grade a road or excavate a site, or to manage a project.
Builders say the shortage is surprisingly bad, given that housing still hasn't recovered from the crash. In fact, they're still operating at about half the pace they were during the boom, and yet the labor shortage is worse. A builder in Columbia, South Carolina tells me he's splitting crews trying to frame houses. He says a lot of workers never came back after the crash, but he also cites immigration laws, saying South Carolina has lost 2/3 of its Hispanic and South American population, and that has had a profound effect on labor. For Nightly Business Report, I'm Diana Olick in Washington.
Here to put the economic data puzzle together for us tonight is Mark Zandi, chief economist at Moody's Analytics. Mark, welcome back. Always great to see you. We've had a week of data one way or another, some of it not so encouraging, and we were cautioned then not to worry too much about it. Others of it pretty doggone encouraging, like housing, with the caveat that much of it is in multifamily and apartments. How do you rank the economy right now? How healthy is it?
I think it's performing well, Tyler. Actually, I'd say very well. You can see that best in the job market. I think that's the best barometer of what's going on. We're creating a boatload of jobs, 200 to 250,000 per month. And just for context, that's double the rate we need to absorb the growth in the working age population. So at this pace, we're working down the unemployed and underemployed, and we will be back to full employment by this time next year. So, you're right. There's a lot of cross currents in the data. There always are. But when you add it all up, I think the economy is performing very well.
What about Stanley Fischer's comments that inflation is still too low? Do you agree with him in terms of what the inflation number means for the Federal Reserve?
Yes, inflation is below the Federal Reserve's target. So the Federal Reserve is targeting 2% inflation as measured by the consumer expenditure deflator, and we are below that. We're running around 1.5%. So about a half point too low. But I do think as the labor market tightens, and as I just articulated, I think it will, we'll start to see wage growth begin to pick up. You know, you'll see it in the construction trades. Diana Olick's report, I think, is symptomatic of we're going to see rising wages, and that will put increasing pressure on prices and inflation. So by late this year, as we go into next, I think the inflation numbers will be very close to the Fed's targets.
Do you expect home building to remain on a strong pace, whether it's multifamily or single family? And if so, could that be an engine for not only economic growth, but for job growth?
Yeah, absolutely. So the multifamily sector, the apartment sector, is just literally booming. The number of homes going up, apartment units going up, is as strong as it's been in almost 30 years. So it's about as good as it gets. Single family home building weak, but that is improving, and all signs are it will continue to improve. And the level of construction is just way too low relative to what we need to absorb the number of households that are forming and all the second vacation homes that are going to get built. So we're going to see a lot more homes constructed over the next several years, and that's also a lot more jobs. And I think that's going to be key to strong growth and to getting the economy to full employment.
A rosy picture, Mark. Thank you very much. Mark Zandi, Moody's Analytics.
On Wall Street, the Nasdaq closed above 5,200 for the first time ever on a strong performance by Google. We'll have more on that in just a moment. But the Dow Jones Industrial Average didn't fare quite as well. The blue chip index fell 33 points to 18,086. The Nasdaq, as we said, gained 46 points to close at 5210, and the S&P 500 tacked on 2 points. For the week, the Nasdaq was the big winner, adding more than 4%.
Dow component General Electric reported better than expected second quarter numbers and issued a rosy earnings outlook, a sign that the company's core business is getting stronger. And that helped send shares up about 0.75% today to 27.24. And as Mary Thompson reports, 2 key deals for GE are expected to get done before the year is out.
In the midst of CEO Jeff Immelt's latest transformation, General Electric posting better than expected profits.
The team had a strong quarter in a slow growth and volatile environment.
Earnings from its core industrial businesses like jet engines and power generators, along with profits from finance businesses it will keep after paring down GE Capital, beating Wall Street forecasts and leading to an improved profit outlook for the full year.
In all, we're confident enough in our performance to raise the low end of our range for our industrial guidance to $1.13 to $1.20 EPS.
The 3-cent add to the low end of the range following a quarter where the backlog of orders for GE's equipment and services rose to record levels. It also came despite continued weakness in a former source of revenue growth, its oil and gas business.
GE is in the midst of selling almost $200 billion worth of financial assets as the company is aiming to generate more than 90% of its profits from its industrial businesses by 2018.
The industrial segment seen benefiting from the firm's plan to buy the French power giant Alstom, a deal delayed by ongoing requests for changes by European regulators.
To get it done, the concessions are going to have to be pretty deep.
Immelt saying he believes GE can satisfy regulators' demands without sacrificing key benefits from the Alstom purchase and expects the deal to close by year-end. Meanwhile, U.S. regulators questioning the sale of GE's appliance business to Electrolux, though here, too, Immelt expects the companies will prevail and the deal will be done by December, closing out what is now turning out to be a better year for GE. For Nightly Business Report, I'm Mary Thompson.
Fellow industrial Honeywell also had a strong quarter. The company said profit increased more than expected in its June quarter on lower costs, even as revenue declined. Honeywell also raised its guidance for the full year. Shares rose almost 2% on the trading session.
Google shares surged, adding more than $65 billion to its market value. You heard me right there. That's the largest single-day gain ever for any company, anywhere, anytime. The stock soared 16% on heavy volume following strong earnings results that we told you about last night. And if you're wondering whether you own it, the answer is you probably do, because Google is one of the most widely owned stocks in mutual funds. The top 3 mutual fund holders of Google, for the record, are the Fidelity Contra Fund, American Fund's Growth Fund, and the Vanguard 500 Index Fund, that according to Morningstar. And as Julia Borston tells us, it's YouTube's growth that's really behind Google's current success.
Streaming video giant YouTube is drawing more viewers and ad dollars than ever. Analyst Mark Zandi calls this Google's YouTube quarter.
It's a real reminder, it's kind of a wake-up call, a reawakening call to Wall Street that they've got this asset that's got 1 billion users. It's seeing accelerating usage growth.
Google announcing that growth in watch time on YouTube has accelerated to the fastest growth rate in 2 years, while watch time on mobile devices has more than doubled from a year ago. To give a sense of Google's scale, on mobile devices alone, YouTube now reaches more 18 to 49-year-olds in the U.S. than any U.S. cable network. And the number of users who come to YouTube's homepage, just like they might turn on the TV, is up over 3 times over the past year. Advertisers are seizing that potential. The average spent by YouTube's top 100 marketers is up over 60% year over year, which Mahaney attributes to the service's new targeting tools and controls.
They've had TrueView in the market where you only pay if somebody actually watches the ad. They've had that in the market for several years, but they've really made it a point to bring out more tools, particularly for brand advertisers, and allow them to really specifically indicate what content they want their ads put against. So the large, well-established brands don't have to worry about their ads showing up against, kitten skateboard videos.
YouTube may be dominant, but it's facing more competition than ever from Facebook and others who are working to draw video viewers and ad dollars. Though YouTube CEO Susan Wojcicki has said she sees room for the whole market to grow. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And on Google's conference call, an executive pointed to Etsy as an example of web companies getting more traffic from Google's reconfigured search algorithms. As a result of that mention, shares of Etsy soared 30%.
Next week will be one of the busiest for earnings this quarter, and there are some names you should pay extra attention to. Bob Pisani with a look at the week ahead.
After a week of financial reports from the banks, we get into the heart of earnings season next week. Now, Google had a terrific report today, and the attention next week is going to be on other big tech stocks, particularly Apple on Tuesday, but also Microsoft. There's a real problem here. There's very little growth in the world, so everyone is piled into those stories that have any kind of growth, like Google, like Apple, like Netflix, and like biotechs like Biogen, which is also going to be reporting next week. In other words, there's a lot of traders hiding out in just a few stocks. That's narrow leadership, a lot of pressure on those leaders. We'll also be getting a lot of big multinational industrials next week, like United Technologies, Dover, and Caterpillar. Now, today, General Electric and Honeywell had very encouraging reports. But again, the weak link is revenue growth. There just isn't much of it out there. The strong dollar and weak global growth are really bad combinations for these multinationals. Fortunately, we've got a few feel-good stories out there. So, General Motors is going to report on Thursday. They're going to almost double their earnings from the same period last year, almost double. And so will home builder Pulte, although there are concerns about higher mortgage rates later this year around those home builders. Now, one nice headwind for stocks are buybacks. According to Standard & Poor's, 20% of the S&P 500 reduced their share count by 4% or more in the first quarter. Less stock outstanding means more concentrated earnings. That's good news. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Still ahead, demand for coal is undergoing a crippling decline, and that is now rippling into other industries.
German lawmakers today agreed for the Eurozone to negotiate a third bailout for Greece. The measure was decisively approved following a warning from Chancellor Angela Merkel that the alternative to a deal was chaos. The Greek parliament has already voted in favor of the austerity measures.
Well, the hits keep on coming for some coal companies. A coal industry pension fund has filed suit against Peabody Energy and Arch Coal over an alleged $800 million worth of liabilities related to the bankruptcy of Patriot Coal. Patriot was created from assets that Peabody and Arch once owned. And as part of its bankruptcy restructuring, it plans to exit the pension and sell some of its assets. That would be a big blow to the industry pension fund, which is deeply underfunded.
Meantime, coal prices have plunged dramatically since their 2011 peak, with the decline accelerating this year, and the tough times may be getting even tougher. not just for the coal industry, but as Morgan Brennan reports, for other industries tied to it.
April of 2015 was the month King Coal was finally dethroned by natural gas as the USA's primary fuel for electric generation. S&L Energy says nat gas accounted for 31% of power and coal 30%. Compare that to just 5 years ago, when coal generated 44% and nat gas just 22%. It's one more piece of bad news for a commodity that's been struggling for years. Waning global demand, a stronger dollar that's making coal exports more expensive, and U.S. regulations targeting greenhouse gas emissions have weighed on the American coal industry. But analysts say the decline is accelerating now for another reason.
Low natural gas is a big threat to coal. It's just when it's this cheap, it's a cheaper burn.
All of this has pushed Central Appalachian coal futures down dramatically, with prices falling nearly 30% in 2015 alone. It's fueled a collapse in coal stocks. Shares of Arch Coal and Peabody Energy have plunged 90% over the past year, becoming microcap stocks. Walter Energy has filed for bankruptcy, and Alpha Natural Resources is reportedly preparing to do the same.
It will just have to go through some hard changes in terms of possibly some bankruptcies and restructurings just to really shed some of this debt. But when we look at coal itself for the U.S., we still think that it's going to be a pretty meaningful contributor to U.S. power generation.
Coal's collapse is having ripple effects on other industries as well, particularly railroads. Coal is still a big business for freight rail carriers like Norfolk Southern and Union Pacific, accounting for a fifth of the industry's overall revenue. When CSX reported earnings this week, it warned volumes of coal for domestic use would fall 10% in 2015. And this morning, Kansas City Southern said energy revenue fell 46% in the second quarter, due largely to coal. For a Nightly Business Report, I'm Morgan Brennan.
Boeing drags down the Dow, and that's where we begin tonight's market focus. The company will take a big charge in its second quarter to deal with a problem with a tanker that it's developing for the U.S. Air Force. The firm says those results will lower its earnings for the full year. Shares were off more than 1% to 146.84. J.B. Hunt reported earnings that rose less than expected. Results were hurt by a decrease in fuel surcharge revenue and poor demand for its truckload and intermodal services. The shares fell a fraction to 84.69.
Shares of Rapid7 went the other way, surging in that company's trading debut. The cybersecurity firm priced its shares at $16 apiece. That was above the expected range and is valued now at about $1 billion. CEO Corey Thomas says the firm is solving a major problem for companies.
Right now, there is still a lack of awareness, believe it or not, in the overall market. And I think what's happened is slowly, with the help of the press, with more awareness, companies are starting to realize that they no longer can ignore cybersecurity.
Shares ended the day at $25.28. That's an increase on the day of 58%. SunTrust Bank reporting earnings and revenue that topped estimates. This is second quarter expenses fell and revenue did slip, and a key measure of lending profitability was off. Shares were off more than 1% to 44.75.
And now to our market monitor, who likes the mid-cap semiconductor stocks he says are poised to do well in an industry that is consolidating. The last time he was on, in May 2014, he recommended Ameriprise, which is up 17%, Cigna, which has gained 76%, and Ingersoll Rand, which is also up 17%. He is Don Wardell, portfolio manager with Ridgeworth Capital Management. Don, nice to have you back. Welcome back.
Oh, thanks for having me.
Are you still sticking with those names that we just mentioned that you gave us back in May, or have you lightened up or eliminated those from the portfolio?
No, actually, we own all three of them still. We think the fundamental stories for all three continue to get better, and especially Cigna. We really like Cigna here for the fundamentals over the next 2 years.
So just repeat your performance here with the picks that you got tonight. I mean, we'll take a 76, a 17, and a 17. You like the
It's that easy.
You like the semiconductor segment. Why?
Well, we do. When you look at our process of dividends, valuation, fundamentals, those are the three things a stock has to have for us to get involved. These stocks all have close to 4% dividend yields. Their valuations are very attractive after the recent pullback. And the fundamental story for all these stocks is very exciting. There's new products. They put semiconductors into Apple iWatches, into automobiles. into a lot of different products that we use, and so they're practically industrial companies trading at very attractive multiples. And so we like the stories fundamentally for the next 12 months.
Let's go through some of them. Your first pick is Cypress Semiconductor.
Sure. Cypress Semiconductor is a company that's going through the integration of a large transaction with Spansion right now. We think that the earnings estimates are way too low in 2016 for this company. Pays us a 4% dividend yield. Operating expenses are coming down. We think upside to $18 a share is fairly easy over the next 12 months.
All right, let's move on to your second one, which is Intersil Corporation. Not one I'm terribly familiar with.
Sure, it's on the smaller cap side. It's about $1.5 billion in market cap. This is a company that has gone through a management change in the last couple of years. Their margins are much better, and we're pretty excited about the future there with the new product on the new Intel chip that's coming over the next 6 months.
And Maxim rounds out the list. You say it's a semiconductor company with dividend exposure to the end market. What do you mean by that?
Well, what we're saying is Maxim has a big dividend. Their end market exposure is, they've got products that go into the Samsung phones. They've got products on the Apple Watches. I mean, there's just some really exciting end markets there that they're involved in. And again, this is an industry that's consolidating, so we think that there's real downside protection here in these stocks. If the global economy were to take a pause here, you've got real asset value, which was demonstrated by the Chinese company bidding for Micron in the last week or so. Shows that these companies are trading way below their asset value, so there should be some fundamental support here.
All right. Well, you haven't steered us wrong yet, Don, so thank you so much. Have a great weekend.
You too. Thanks for having me.
Don Wardell with Ridgeworth Capital Management.
And coming up, the big money behind the music for one small business.
Here's what to watch for next week. Besides a busy week of earnings, lots of housing data with a report on existing home sales and new home sales are out. Weekly jobless claims will offer us a read on the labor market, and a gauge of manufacturing with the Purchasing Managers Index will be out. And that is what to watch next week.
2 breaches disclosed today. Hackers broke into the hospital network of the University of California at Los Angeles and were able to access records of 4.5 million people, including names, medical information, Medicare, and Social Security numbers. Separately, the CVS photo website was shut down due to a possible breach. CVS said that customer credit card information may have been compromised.
And finally tonight, a family business that has certainly stood the test of time. It started hundreds of years ago in Italy and is still thriving today in a suburb of New York. And while most family businesses fizzle, this one is alive and well. Kate Rogers introduces us to the Didario family.
In a manufacturing facility in Farmingdale, New York, Jim Didario is keeping alive a family trade that dates back more than 3 centuries. It began in Italy in 1680 in a town called Sali.
That little town was pretty famous for string makers, and still to this day there are 4 family businesses that came out of that town that are still making strings.
Jim's grandfather, Charles, brought the tradition to America when World War I embargoes disrupted his string importing business. Jim's father joined the business in the 1930s, and Jim was just a teenager when he decided he too wanted in.
Once I fell in love with playing the guitar and being in a band at 13, 14 years old, I suddenly became kind of the string tester and the product development guy at a very early young age from my dad. He would bring home samples and say, try this.
The family business has come a long way since 1680. We're standing in a 110,000 square foot facility where they manufacture 700,000 guitar strings a day.
What we do today, my grandfather probably wouldn't even recognize.
The facility is constantly being updated. Last year, Didario invested almost $10 million in new technology, which enables the company to make 95% of its products in America.
These are the most sophisticated machines we have.
Didario employs 1,200 people and projects $175 million in sales this year. Global exports make up half the business. The company has 50% market share, including its private label business, with some of the biggest names in the music industry using its products.
We've had some people like Pat Metheny and John McLaughlin from the very beginning in the 70s, and today we have really big name people like Keith Urban and Vince Gill in the country side of things, Lenny Kravitz, Joe Satriani.
Didario has transitioned from making just strings to manufacturing drum heads, reeds, and other music accessories. The next big hurdle, succession planning. Jim says there are 9 family members in the wings already working for the company.
We've gotten successfully to the 4th generation, and we're hoping that we could put the right governance in place and the right systems that it could perpetuate itself and go on for as long as possible.
For Nightly Business Report in Farmingdale, New York, I'm Kate Rogers.
Amazing story, but succession planning is one of the big challenges for family-owned business.
So hard for family
Really
business.
is.
It's amazing to see how people make money and
I
make
know.
a living.
Who would have
Strings.
thought? Strings.
Guitar strings.
But they're doing a good job
Great.
of it.
A lot of strings.
That'll do it for Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great weekend, everybody, and we'll hope to see you right back here on Monday night.